Hello, everyone. My name is Jonathan, otherwise known as Sheen Trades, and today we'll be going over how to read the data charts with the Apex dashboard by TraderLink. Starting off, I'm going to be going over the outline and the lesson plan for today. So more specifically getting into it, we will go over how to read the data, gamma exposure, the volatility curve and how it relates to gamma exposure. Next off, we'll be going into Vanna exposure. And very last, we're going to go into how to read the cheat sheet, which is actually the simplest way to break it down from 4 down to 2 different hedging requirements. Terminology plus the cheat sheet. Vol is actually short term for volatility. AOI is short term for area of interest. As a disclaimer, this cheat sheet isn't going to be perfect or exact to the very T. A lot of the hedging requirements are subject to changes in other exposures. However, specifically for gamma exposure and Vanna exposure, this is what we managed to break it down into. For the cheat sheet breakdown, typically how you want to go about looking at the cheat sheet is simply go column by column. You can easily break it down from 4 choices at the underlying price movement down to 2 different rows. Today, we will be breaking that down with an example. Now we'll be going back and forth to show you exactly what I mean. The best days to trade and the days that I suggest you actually focus on are the ones where you get a bias hedging requirement, either a buy stock, or a sell stock, sell stock. You don't want to typically trade days that are buy stock and sell stock just because it will be relatively balanced for the day, or otherwise known as chop. So gamma exposure, as you can see from the screenshot on the right, this is typically how I go about breaking it down. So first off, I go by identifying the environments, aka positive GEX and positive Vanna exposure. The next step is identifying the AOI, or the area of interest, which in this case just so happened to be 4,600. Then you break it down into 2 different scenarios, right? Increase in the underlying and decrease in the underlying. What happens to volatility or vol when you increase, and what happens to volatility or vol when you decrease. Looking at VEX to confirm the specific levels of volatility, and then you can go into a deeper level of simple quantitative math, or as we call it, quant math. So for the example today, 4,600 AOI, increase in the underlying, vol gets higher, and dealers would have to buy stock. So as you can tell, what I mean by that is the spot price starts increasing, right, in the underlying, and then the AOI is 4,600, as we pointed out right here, right? That will inherently go in the opposite direction as the stock continues to push up, and the 4,600 strike price actually goes more closer to the money and even in the money. And with that being said, it is actually increasing in volatility as we increase, right? The AOI is increasing in volatility as we increase. This is just for this specific example. You can definitely run into different ones, and we'll break those down when we get to that area, right? The next step, as I said, is you want to go into what happens when you increase and when you decrease. So in the same exact screenshot here, right? Now we find out the case scenario for when we decrease. So when you're looking at this, the spot price decreases with this yellow arrow. It goes down to the left, and the AOI at 4,600 follows the opposite side, and it starts increasing in vol as well, right? So as you can tell, we broke it down right here. These are the specific ones. So gamma exposure is positive, and you can tell by seeing this number amount right here. This isn't actually the Apex dashboard. These are just the history or the historical screenshots that we have of it on a minute-by-minute basis. But for that case, this is just what we're working with today. So once again, I want to break it down. Gamma exposure is positive. You can tell by this number up here. Vanna exposure is positive, and you can tell by the same number up here. Oh, sorry. That's the next slide. I apologize. But for gamma exposure specifically, you can tell by that number up there. Going into the next slide, gamma exposure, quant math, right? This is very simple, yet also difficult to do at the same time. However, we're going to break it down. So it's hard to see, but if you actually notice, the AOI as the underlying price decreases, it actually loses volatility or vol for a bit, for about 5 to 10 points, right? And before it begins gaining volatility once again, if we follow the same steps that I showed you before on how to figure out what happens to vol as we decrease, the spot price goes down and the volatility actually drops down at the 4,600 up until about 10 points in before it starts increasing. So you can now take this and go 5 to 10 points below the current spot price to determine at which point does the AOI begin increasing in volatility again, in which dealers actually need to buy back when that AOI starts increasing in volatility. I can go over this many times. If you have questions, you can always ask later in the Discord and I'll be there to help. Next slide is Vanna exposure. When looking at Vanna specifically, you want to determine whether or not something is low volatility or high volatility. From the previous videos we talked about, a small bar equals high volatility and the big bars equals low volatility. One thing to take into account is that yes, 45.75 indicated by this red arrow may look small, but relative to the strikes that it's in between, it is much bigger than the other two, right? To me, that suggests that it is high volatility compared to the rest. And with that being said, I consider that area a low volatility area, right? Gamma exposure, as you can tell today, there was a relatively balanced day, or otherwise known as chop. However, in the morning, we managed to call out 45.75 as the bounce area after doing some quick math, and you can go back in the presentation or the recording and go to the screenshot that I sent or that I posted on the slide, right? However, in the morning, we called out 45.75 as the bounce area by doing just the simple quant math that I talked about, and I labeled that here 45.75 quant math, right? Buyback zone. So there was other reasons to aid the end of day pump, such as delta exposure being too negative at 4,600, and dealers would actually need to get closer to a neutral state, right? Keep in mind, we always talk about delta hedging. And what delta hedging is the dealers want to have a zero delta, right? With that being said, if the delta is negative, they would need to buy back shares to decrease the amount of negative delta and get it closer to zero, right? Going over the screenshot, this is just a snippet for the next video that I'd like to go over so that we can get into some details later. As you can see by the yellow arrow pointing at the delta exposure chart, there was a huge negative amount of delta exposure at 4,600, as I said earlier, right? With that being said, understanding the mechanics of hedging, right? In order for a negative delta to get back to zero, dealers would have to buy back shares in order to lessen the amount of negative delta. And this is for a vice versa for positive delta. If they have a positive 150 delta, guess what happens? In order to get it down to zero, they would have to sell shares to bring that delta back down. All right. Thank you for tuning in. The first link is to the Trader Link beta test. Sign up if you haven't. The next link is for the Apex dashboard Discord, right? This is just for support. We answer questions. We help out traders in the sense of trying to understand the data and get to know it a little better. And thank you very much for tuning in. Have a great day.